This is a look at what could eventually happen to the dollar. I have identified that there is a complex interplay between US debt management, global de-dollarization, and the domestic money supply. I propose a scenario of a temporary rise in the dollar's value during a transitional period to its ultimate demise. Let's unpack some pointers and analyze the potential economic effects. 1. The short-term bond cycle and demand for dollars. The US Treasury has been issuing a greater proportion of shorter-term debt. This duration shortening is often used as a strategy to manage interest costs, as shorter-term bonds typically have lower interest rates, but as confidence in the dollar erodes, this interest rate will increase to the point where it will cross with the interest rates of long-term bonds, and this will be a signal that will stand out from the noise. The global bond market. The US Treasury market remains the largest and most liquid in the world, even with de-dollarization. When a short-term bond matures, the US Treasury has to pay back the principal. To do this, it often issues new bonds to raise the cash in a process called rollover or refinancing. The temporary demand. Here is where the theory gains traction. If foreign countries and investors still hold a significant amount of these short-term US bonds, they will be paid back in dollars. As these bonds mature, those foreign holders will receive a large influx of dollars. To reinvest this money in the US market, or even to convert it to another currency, they still need to transact in dollars. The scarcity effect. If de-dollarization is reducing the overall global supply of dollars, as countries aren't accumulating new ones, but the US is still pumping out a lot of short-term debt, there could be a temporary mismatch. The need for foreign investors to buy newly issued US debt to maintain their portfolios, combined with a limited supply of new dollars coming from trade, could create a temporary surge in demand for the dollar. This is my proposed temporary rise in dollar value. 1. The internal versus external dollar circulation. This is the core insight. The two forces described are 1. Reduced external circulation. As countries use the dollar less for trade and as a reserve currency, the flow of dollars outside the US system decreases. This is the de-dollarization effect. 1. Increased internal circulation. The US government, by issuing more short-term debt and needing to constantly refinance it, is essentially creating a massive amount of dollar-denominated financial assets that need to be bought and sold. This could lead to a very large and active internal circulation of dollars within the US financial system, and because they are not being bought by the wider market, remain within the US. 1. The consequences. Why the strange effect occurs. The temporary dollar strength, followed by its eventual devaluation, would create a very volatile and disruptive environment. Temporary strength. The dollar would become temporarily more valuable against other currencies. This would make imported goods cheaper and US exports more expensive, potentially harming US industries that rely on foreign markets. The blowback of devaluation. The temporary strength is not sustainable because the US would be forced to create more dollars to manage its debt and deficit spending. This creation of more dollars would be the ultimate devaluing force. As the US has to print more money to cover its expenses, the dollar's value will eventually plummet. The domestic inflationary spiral. The influx of new dollars would flood the domestic economy. This is where the second point from the initial question comes back into play. This increased supply of dollars within the US, combined with the eventual decline in the dollar's value, would lead to massive domestic inflation. Everything from consumer goods to commodities would become more expensive as the currency's purchasing power is eroded. Global instability. This would not be a smooth transition. Other countries would be watching the US dollar's wild ride. The temporary strength might encourage some to dump their dollar holdings, accelerating the de-dollarization process. The eventual collapse in value would create a global shockwave as countries that still hold dollar reserves or trade in dollars would see their assets lose value overnight. Summary. There are complex feedback loops at play, causing a two-stage process. 1. Stage 1. Temporary. A de-dollarizing world, combined with the US's heavy reliance on short-term debt, creates a temporary, artificial scarcity of dollars on the international market, leading to a temporary rise in the dollar's value. 1. Stage 2. Permanent. To continue paying its debts, the US has to create more and more dollars, which floods the domestic market and ultimately causes a sharp and permanent devaluation of the currency, leading to high inflation and global instability. The economic narrative is not simply a supply and demand model, but has completely highlighting the unique risks associated with the US being the world's reserve currency and its current debt management strategy.